And here to explain what's happening on Wall Street is David Waddell, CEO and Chief Investment Strategist of Waddell Associates. David, it has been a common historical pattern that global markets usually weaken as war approaches. Why is that?
Well, that's where the anxiety starts to build, right? So the common saying is that you sell the markets when the tanks roll and you buy the markets when the tanks fire. And that's what happened today. So once you've discounted things down like we have in the S&P 15%, really top to bottom, then you've really done a lot of technical damage to the markets. The anxieties have registered, you get people super pessimistic, and so all the sellers sort of clear out because they always, in times of war, expect the future to be worse than often the reality becomes. And so the market got very oversold in advance of the invasion today. And then I think what mattered most is that the sanctions that Biden addressed in his remarks were really somewhat benign. They didn't really impact what's going on in the oil fields. It didn't really impact what's going on with the SWIFT system so that, Germany can buy energy from Russia. So it targeted banks, it targeted some state-owned enterprises, it targeted some rich people. But the big risk in all of this is that it really roils the energy markets, and the sanctions weren't directed at energy. And so that's why I think we got to rally today.
Got it. On a scale from 1 to 10, with 10 kind of being the worst, how bad are things on Wall Street at the moment?
I think they're pretty good, actually, because everybody thinks they're really bad. So in times of uncertainty like this, the indicator that I look at is sentiment. And right now, sentiment is in the bottom 2% in terms of optimism. It's been going back 35 years. And whenever sentiment's gotten this blue, basically in that set, markets were 25% higher a year later. So the sellers have sold, the sentiment is sour, and that's when you want to buy. You don't want to buy when the market's euphoric. You want to buy when the market's fearful, especially right now. And behind this, the economy is still growing. Earnings are still growing. Yes, the Fed is going to engage, but this probably means that the Fed increases interest rates less. So people were fearful of a 50 basis point hike on March 16th. I don't think we get that. I think it ends up being 1/4 of a point. Valuations have come down a lot, and there are a bunch of cheap places to be in this market. So I don't think this really derails the story for the year. There may be more chop around it while we find footing. But if you could sort of, buy and then close your eyes and reopen them in a year, I bet your statement is bigger.
All right, that's good to hear. As we heard from President Biden, he said the notion that this is going to last for a long time is unlikely. And it sounds like, based on what we're talking about, you agree.
I do. I mean, Russia goes in, it may take down the capital here shortly. They set up a puppet government, then they have to deal with sort of all the guerrilla issues that you'd have in a conquered nation. But the oil fields aren't being attacked, right? We're not blowing up pipelines. And so, the sanctions, again, will be determined by those who impose them. And, that stuff will ricochet back on Europe if they demand something happen with the oil supplies or with the wheat supplies or with the other supplies. I just don't think they'll do that. So Russia is going to have a challenge dealing with the Ukraine, but I don't think the sanctions are going to bite so hard that it's going to derail the global economy. There's still a lot of stimulus in the system. There are no real recessionary indicators on my dashboard. And by the way, markets appreciate 88% of the time in a year when you do not have a recession. So, we're lower now. I think maybe we're higher by year end.
We've kind of talked about stuff happening, within a time period of a year, but what happens kind of in the short term? Maybe what are some next steps that investors consider? Is it simply closing your eyes and waiting?
I honestly think that's a pretty good strategy because when you open your eyes, you get full of, a whole lot of things that make you overreact. That doesn't mean I don't think the market could go down a little bit more in the near term. There could be some disruption. There's a risk that NATO gets engaged militarily. I don't think that's going to happen. There's a risk that there's a cyber war attack on the U.S. or something like that people are fearful of. I don't think that's going to happen. The best analog for this moment, really, is when Iraq invaded Kuwait. And when that happened, the stock market went down about 16%. That was a surprise. This is not a surprise. So we've already discounted it 15%, not too dissimilar. And so if you'd have bought on the day that Iraq invaded, and you looked out a year, the market was up 20%, but it did go down after that for another month or so before it bottomed in October. So between August and October, the market trended lower, but then, either from the bottom or the moment of the invasion a year out, you were fine. So it can go lower in the near term, but I still think it's viable here. And if you can get it at cheaper prices and you still got a little powder left, I think you go there. But that's a 3-month sort of outlook. Who knows? It's very hard to predict the market over the next 20 minutes. It's very easy over the next 20 years. And that's what makes this business so interesting.
Well, David Waddell, we appreciate you trying and coming on and explaining it to us.
Sure. Happy to be with you. Thanks for the invitation.